I want to keep the focus on the financials. I want to bring in our friend of the show and also a Wall Street insider, of course, Evercore Partners President and CEO Ralph Schlosstein, just returning from Europe, right? From London.
Yes, that's correct.
And an acquisition.
Yes.
Lexicon Partners.
Yeah, it's a great enhancement of our franchise in Europe. We're trying to build a business there comparable to the one we have here in the U.S., and this is a great first step for us.
Right. I remember when you were on our show last time, we were talking about international growth, and,
yes.
and that sort of being a big part of the story here. You just heard from Berkowitz, who is saying that the trends are improving among the banks, right? But I want to just, Ralph, show you a stock chart that we put together. Your shares, by the way, Evercore, have gone up about 4% so far this year. But if you look at Goldman Sachs, you look at any other banks, we picked out GS and also Citigroup. Those stocks have gone down about 20% plus so far this year. So if the trends are improving, why are they not being rewarded for that, do you think?
Okay. I think the first and most important thing that investors are starting to realize is that the return on equity of these large financial institutions is going down relative to what it was historically. It's going down for a number of reasons. Capital levels are much higher, regulation is more strenuous, and the overall level of speculative activity is lower. And after all, Wall Street makes money on transactions, money passing from one to another. So if the volume of activity is down, that also hurts Wall Street profitability.
But why this divergence, though? Do you think? I mean, as we were just showing in that chart, though, I mean, your business is growing. You're doing very well. But it's these big Wall Street firms, though, that are getting punished right now. Is it because of regulation in many ways? I mean, which you did point out as one of the three reasons.
Yeah, I think the biggest reasons are much higher capital standards and lower velocity. I mean, if you look at equity trading, fixed income trading, they're all down relative to history. But regulation certainly does play a part. You have to remember a firm like Evercore really competes in only probably 5% of the activity of a Goldman Sachs or a Morgan Stanley, the advisory business. So it's the other 95% that's being affected by these very large trends.
Ralph, what did you make of Jamie Dimon taking on Ben Bernanke earlier this week?
Well, I think it's a wake-up call to make sure that we don't overcorrect in our regulatory actions. I think what often happens, it happened with Sarbanes-Oxley, and it's happening a little bit in the financial services world as well, is that when we have these cataclysmic events, we tend to overcorrect in the other direction and have too strong regulatory footprint. And I think Jamie is he's never denied the need for some of the actions that were taken as a part of Dodd-Frank, but I think he's just carefully pointing out that we want to make sure that we don't stunt economic activity and we don't harm America's financial institutions' global competitiveness.
So then, Ralph, I'm trying to figure out then you do agree with him then? You do agree?
It's less of an issue for me in our business, but I do think we need to be cautious about overregulation.
As a crimp on economic recovery.
On both economic recovery and on the global competitiveness of our financial institutions.
And yet you have somebody like Sheila Bair who comes out yesterday and says she's basically not buying it. She's saying, look, you know, the regulators haven't been tough enough, in fact, and she doesn't believe that these capital requirements would prevent any bank from the big banks from lending.
Yeah, I don't believe, first of all, these new capital requirements are being phased in over many years so that their impact on the economy is minimized. In that respect, I'm more in the Sheila Bair camp than I am in the Jamie Dimon camp. However, I do believe there is justification for added capital for these larger institutions for two reasons. Number one, by definition, a large institution is systemically more important than a small or medium-sized community bank. The second reason is if you look at the riskier activities, proprietary trading, principal investing, more active capital markets activities, you don't find those at a community bank, which is just lending. You find them in the Goldman Sachs's and the JP Morgans and the B of A's of the world. And those activities do require probably a greater capital cushion behind them just than plain old local banking, lending to businesses and to consumers.
But Ralph, we had Simon Johnson on earlier this week who says the answer is not higher capital cushions, or at least the capital cushions that we're talking about are not high enough. He says the answer is to just break up these big banks, make them smaller so that they're not too big to fail.
Well, I think the problem with that is that the activities that these big banks are carrying out require scale. Market making, derivatives, which have an important part in our economy,
what we've seen in
our society,
2008.
outside of speculation, underwriting activities, secondary trading activities. Those require large balance sheets, big, deep organizations, and there's no way there's a reason regional banks don't play an active role in those businesses, the smaller and medium-sized ones, because they don't have the ability to attract the best talent. In fact, one of the dangers could very well be that we break up these institutions and we wind up with less talented people running these businesses in many more institutions.
And therefore jeopardizing perhaps the prominence of the U.S. as a financial center,
well,
then?
Definitely.
Okay.
I mean, when you look at the concentration of banking and securities activity in the larger other markets other than the U.S., we are competing with some very, very large institutions. And the idea that we would take a $50 billion balance sheet regional bank and put them up against Deutsche Bank or Mitsui or Mitsubishi is kind of a silly idea.
Ralph, you were talking earlier about this sort of the declining return on equity, right? That basically why these stocks are getting punished. That's going to result in layoffs on Wall Street, or more layoffs, is it?
Well, I think the first thing that happens when you have a declining return on equity is managers of these businesses try to figure out how to boost or bolster the return on equity. Revenues are not growing rapidly, as we all know, because the economy is growing slowly and the volume of activity is relatively low compared to previous times. So the second way that one boosts return on equity is to cut costs. There are two ways that one cuts cost in Wall Street. One is by reducing compensation, and the other is by reducing the number of people that work in these firms. I personally believe we're going to see both.
You personally believe what? Excuse me?
Believe we will see both.
You'll see both?
Yes.
Okay, but it looks like layoffs first, perhaps? Before?
Well, normally these institutions pull back on compensation a little bit first, but I think we will see both.
Okay. Ralph, thank you so much for stopping by.
Sure. My pleasure, as always.